Hi, everybody. Chris Englebert with Englebert Financial Advisers in beautiful Allentown, Pennsylvania. And we are in the first of the month of April. You can see we got blossoms around, but we're going to be talking investment strategy for the month of April. How did March finish? It was all about the banks, banks, and more banks. Again, the news cycle was dominated by a couple of banks that obviously got into trouble, and we saw failures, takeovers of these banks, and the entire banking sector cratered about 30% in literally a week's time. So what did that do to the market? Well, interestingly enough, you can see my chart of the S&P 500, and the first part of March, the banking news caused the S&P 500 to pull back almost 6%, but then almost as quickly we turned around, and on the back of large cap technology, we had a vicious rally into the month end. And so far for the first week in April, that rally in the S&P 500 and more importantly, the NASDAQ has continued to take off. Now, a lot of people are saying, why are we getting these rallies in this tech stock? And I want to get a little bit in the weeds right here. And on my next chart, I'm going to be talking about the 10-year treasury or interest rates. Now, one of the things that's considered, and if you hear the buzzword long duration assets, all that is a fancy term for investments that are meant to be held a long time in order to see some kind of rate of return out of them. The ultimate long duration asset is considered cryptocurrencies, and then after that, considered tech stocks. So when interest rates were low, long duration assets, i.e. tech stocks, rallied furiously in 2020 and part of 2021, peaking in November of 2021. Then interest rates started to surge in 2022, and we saw the NASDAQ, or long duration assets, down almost 30%. Well, lo and behold, obviously the rally that we saw happen the last part of March was due to the fact that interest rates dropped dramatically. There was a flight to safety. Anytime that there's a worry about banks or international war breaking out or whatever the case may be, and you hear the flight to safety trade, that means institutional investors are selling stocks and buying bonds. Well, what ended up happening, and you can see in my chart here, the 10-year treasury, was that in the first part of the year, January through February, interest rates dropped. And then worries about inflation, we saw interest rates zoom back up to literally over 4%, only to drop rapidly during the banking crisis. And updating this chart a little bit, interest rates on the 10-year treasury are now below 3.25%. So what ends up happening when interest rates drop? You see long duration assets, i.e. tech stocks, ramp up rather dramatically. Now, do I think that tech stocks are going to continue their rally this year? Possibly in some of the areas out there, they will, maybe in the semiconductors. But again, people are very concerned about the other shoe to drop, and that's the payroll report that's coming out. And by the time you see this video, it will have been out. Well, we're beginning to get some precursors that literally the jobs market is beginning to soften up, and everybody's screaming, we're going to be in a recession, we're going to be in a recession, we're going to be in a recession. Well, this is the most telegraphed recession I've ever seen in my career. And I show you a chart that shows how much cash people are hoarding against the impending or the upcoming recession. And you can see by my chart that you have investors sitting on more cash than they did in 2020. So I believe what's going to happen is that all this cash is going to put a floor under the stock market. And I still believe we're in the stock market trading range. I believe that we're at the upper end of the trading range. At the end of December of 2022, we were at the lower end of the trading range. I would not be surprised sometime this summer to see us maybe visit the lower end of the trading range again. But again, I'm not looking for a big 20, 25, 30% sell-off because there's so much cash sitting on the sidelines. And once stocks pull back, everybody comes piling in saying, hey, look at this from a value play. So again, a lot of cash sitting on the sidelines. The question will be, will the tech rally continue? So the banking crisis at the beginning of March started a stock market sell-off, which quickly turned into a rally by the end of March, led by the tech stocks. We have seen interest rates decline. So all of you bond investors are seeing a much different investment profile, much more positive investment profile this year than you did last year. When interest rates were being cranked up last year, bonds had their worst year ever, down 14 to 16%. Well, right now, as interest rates decline, we're beginning to see bond returns of the 2 to 3% for the first quarter of 2023. I would not be surprised if interest rates decline further. You could see bond returns for the year coming in 4.5%, 5%, 5.5%, which means that bond investors are doing a lot better this year. As far as stock investors go, we saw a big rally in tech stocks. Dividend stocks kind of pulled back, but we still believe that the dividend stocks are going to ultimately be the place to be in kind of a sideways trading market for the rest of 2023. So that's the first of the month update. We appreciate everybody for watching. We'll be back soon. Thank you.